Welcome to the DIY Sessions. I'm Ranjan Balakumaran. The producer is Drew McFadgen. Today we're joined by Bank Confidential, Steve Middleton and Mark Wright. Steve, hello.
Hello, Ranjan.
Steve, what is Bank Confidential? What do you do?
Bank Confidential is a not-for-profit company set up by Mark to help protect whistleblowers in financial services. Mark used to work for RBS and went through some very difficult times with them, trying to expose a number of issues that happened when he was there, the usual bullying and harassment that people face. And we decided we wanted to be able to try and help protect other people so that nobody else would go through the same. I think the word now. Nobody else would go through the same problems that Mark did.
Mark, how long have you been going?
Well, we actually launched February last year, and to be quite honest, our feet haven't hit the ground really. To be quite honest, it's been quite substantial with the disclosures that we are having from whistleblowers approaching us really concerned.
You've got a story about GPs that we were going to talk about today. Can you tell me a little bit about that case?
Yeah, this is one that I confronted the FCA and Andrew Bailey over at the annual meeting last year.
Oh, sorry. Who are the FCA? There's going to be lots and lots of acronyms, alphabet soup. So every so often I'm going to ask you to just explain what one thing means or whatever it is.
The Financial Conduct Authority are a regulator, and they regulate all of the financial services firms, including banks, financial advisors, insurance companies, those type of things. So we refer to them as the FCA. They're quite a powerful organisation. They have about $500 million a year of income, 3,500 staff. And their job really is to, in theory, keep the city and the financial markets working properly and also to protect consumers.
What have they got to do with doctors, local doctors and GPs?
Well, I started falling out with the FCA back in 2014 because there was an issue in the financial markets where many businesses had been sold what are called interest rate hedging products. People refer to them as swaps or derivatives. They're quite a complex product that you would normally only sell to somebody who was very sophisticated as an investor. But the banks had sold these to many unsophisticated business people.
And you know this because you're a financial advisor?
Yeah, 25 years as both working at the banks and then as an independent financial advisor.
Okay, so the banks have sold certain products to lots of business people.
To give you an idea, when I say a complex product, usually people might buy into shares or maybe something like a unit trust that includes shares, so you get a kind of diversified investment. And those investments always carry some form of risk, with stock markets going up and down, or if there are gilt stocks in them. So as an advisor, part of your job is to always ensure that you're only putting forward the right products for the right type of customer.
Okay.
That's one of the biggest issues that you have in terms of meeting with the FCA's responsibilities. And the biggest issue you have to consider is the extent of the risk in any product. When somebody approached me back in 2014 and they had one of these products, and they also were under massive pressure because they were in RBS, Global Restructuring Group, so the Royal Bank of Scotland, what's classed as the GRG arm, in theory for businesses in trouble.
Sorry, just to clarify, as a financial advisor, somebody contacted you and they said that their business was experiencing difficulties and it might have been something to do with buying some strange product.
Because I used to deal with a lot of commercial finance, they actually asked me to help out in negotiations with the bank because they were at risk of insolvency.
Okay, so this is a person who has come to you and said, I have a small business. So could you tell me a little bit more about that person and what they were going through?
Yeah, I probably can't really say what the businesses were. There was a multiple of businesses. They owned some properties. They were trading business and property investments. And what happened, they had been sold one of these derivative products. And they had been pushed into this area of the bank, GRG, where you were effectively facing defaults on your loans. So at that point, you are close to insolvency.
Okay, so they're nearly bankrupt now.
They're approaching that with the businesses.
When they contact you, right.
And so I managed to negotiate with the banks not to take any further action while I investigated what the issues were. And what we quickly saw was that they'd been sold one of these fixed-rate loans. So people talk about them as a hedge or a swap. Effectively, what's happened, the bank have told the customer that rates are likely to go up in the near future and rates are historically low. So what they should do is fix their rate.
The bank has told them their view on how interest rates are going to change, and they say, if you buy this, then you will be okay.
That's an interesting wording. The bank hasn't actually told them their view. Their view was that rates were going to go down. What the bank has actually told them is a view that will encourage the person to buy a product that will make the bank an awful lot of money. The bank form a view on interest rates based upon forward yield curves. They have many economists and traders and treasury people who are day in, day out monitoring these forward yield curves to see where the expected rates will go.
They have their own view on the future, and they are telling people, such as, for example, your client or even GPs. So did they do this to GPs? And
they did it to all of the businesses, but they particularly targeted GPs.
Can you tell me a little bit about what the GP story is?
Okay, well, just to explain a little bit more about these swaps.
Yes.
What will happen? You will buy a fixed rate, and the bank will keep the variable rate. So if rates drop, so as a simple analogy, let's say if you fix your rate at 5% and rates are 5%, and you have £1 million loan, for every 1% that the rates go down, you will owe the bank £10,000 a year over the term of that loan. So effectively, you're betting against the bank. Now, what happened, RBS, to give you some history of RBS's position, back in 2007, RBS were in severe financial difficulties, and they were losing many of their own bets with other traders in terms of where rates would go. So they had a lot of rates that they would prefer not to have on their books, shall we say. And one of the areas they targeted in terms of how to sell some of these rates on were GP practices and businesses in the healthcare sector.
So the bank have made a series of separate predictions about where the future, about what interest rates would be, and then afterwards they then find other people like GPs and they make them take predictions as well.
The best way I can describe it, most people, or a lot of people, have seen the film The Big Short. And what you see there is a trader called Paulson who is actually looking at the bank's debt structures, and he sees that they have a big problem with subprime debt. So he's actually betting against a number of the debt products that the banks have packaged. And he believes that the subprime debt in the US and elsewhere will eventually cause these loan packages to default. And that's in 2006. People believe the crash happened in 2008. The crash started in 2006.
All I can hear is a bunch of people betting against each other.
Traders globally betting trillions and trillions of dollars.
And then you were saying something about how you have experts who have some idea what's going on, and other people who have less of an idea.
Well, when we say experts have an idea, I'll show you a screen print there, Ranjan. That's from a system called Blomberg. People who deal in the treasury area, so people who sell treasury products, buy this system. It's an expensive system to buy, but multiple traders have these systems, so the bank will have thousands of these systems globally, and even smaller trading practices or firms will have this system.
Steve's just showed me this picture of graphs, two lines, one going down very, very steep and the other one going down not so steep.
I'll come back to that in a second. It's just explaining the fact that the bank, if they say to you what nobody really knows where interest rates will go, which is what was commonly said to their customers, is an interesting statement to make, because they're actually selling products from traders who are looking at these screens all day long. So the idea that you're not too sure or have no idea where rates will go, or you believe rates may go up, would all be very spurious statements to make, because they have very strong predictions on where rates will go.
I have this kind of theory, which is that not everybody has the same access to information or knows how to interpret it. And that unequal access to information means that some people can take advantage of people, and some people end up in lots of trouble.
Well, if I make a simple analogy, let's say if one of these businesses was a car mechanic or a carpet salesman, or a cleaning firm, would you expect them to have a Blomberg system that could go and switch a button and look at their forward yield curves? And nobody had ever heard of the system.
In terms of trust, Mark, you ran a network of banks for NatWest, didn't you, for many years? What does all of this say to the average listener about trust? Have they been too trusting? Should we never trust anyone?
I think that based on what I probably saw in maybe the last 10 years, before I left NatWest/RBS in 2013, there was nothing that you could trust with regards to the culture, the behaviour. I just want to pick up on what Steve mentioned there, because it was always the case that was there an element of scaremongering to clients out there that rates are going to go in an upward trend. All I can say is, Ranjan, having access to the chief economist report almost on a weekly basis, I never, from 2006, 2007, saw anything that would give any predictions that rates were going to go up. We were always told that we were likely to see eventually get to more zero interest rates, and they were going to stay for a long, long while.
I get the impression that you weren't the person selling these swaps then.
No, but the important thing to also bear in mind when we talk about these specific products that are clearly now starting to come to the forefront, and how toxic and how bad these particular products were, and I can tell you now, and this is absolute fact, that there is a directive that came down from the very top at RBS to all of the senior relationship managers and corporate managers, and that is that any clients that had in excess of £500,000 worth of borrowing, the bank was very clear that they wanted all of that borrowing in interest rate hedging products and swaps. So you can actually see where we're now seeing the fruits of that labour, as it were.
Okay, so I understand RBS was the biggest bank in the world at the time, and what you're saying is that there was a sort of offloading of these types of complex products to everybody.
Absolutely.
Yeah, you would normally call it switch selling. There was a number of trading houses were fined for it a few years ago, but it's very interesting because the FSA's own report into the failure of RBS criticises their ability to offload their bad positions, shall we say. So imagine getting caught with a particularly volatile, particularly dangerous investment and risky investment. Would the right thing to do be to go off and try and sell that to one of your friends or your customers to get rid of that risk onto their balance sheet instead of on your own? That's what the banks were doing.
With this type of culture of mis-selling rife, and they're offloading these bad positions, or they're selling these toxic products to everybody. Can you tell me a bit more about the human cost? Because I know that you've got the people working in the banks that know about this, and you've got the victims who are buying this stuff.
Well, let's go back to this GP case that I mentioned.
Oh, yes.
What RBS realised is that there was a very good income stream from NHS monies. So the NHS could distribute money to primary care trusts, who could then pass monies on to GP surgeries for building and renting surgeries.
Okay, so the NHS, that's taxpayer money,
Yeah.
is going through to primary care, which is basically not hospitals but GPs.
Yes. Medical centres as well, though.
Okay,
And
so
veterinary and lots of healthcare areas. Yeah.
so banks recognise that taxpayer money is going to these what are called primary care, GP, and medical centres.
Yes.
And they target them, do they?
Yeah, because if an income stream from the NHS at the end of the day, it's blue chip income. It's the government is backing the income. So if you're wanting to raise funds in the market, which is how banks work, their treasury arm are the people who raise the funds, then a gilt-backed income stream is a very valuable income stream.
So if I'm a bank and I lend money to a GP, I can turn around and say, I've got a guaranteed stream of cash coming in. Can I borrow some money off this guaranteed stream of cash that I've got?
The treasury arms, they raise funds in the market. So when people have debts, those debts are credit rated, and the strength of the credit rating allows them to raise more monies, and banks leverage massively against the income streams they have.
Leverage massively?
I'll go on to that when we talk a bit more about the swaps, but the reality is for every pound that comes in, they might be borrowing £3, £4, £5, £6, £7, which is why you often end up with this liquidity issue, because they have this very robust balance sheet but very little real cash behind it.
So for all of the money that they've got going on in transactions, there's very little money there.
RBS had a particular problem because they had such little cash that they didn't even meet the minimum requirements for banking standards in 2007. The banks have to report under something called the sterling liquidity ratio, where they've got to have a minimum of 100% of a set figure, and that's a protection against a run on the bank. So it's basically a number of days, which is approximately a week, and how much cash might get withdrawn within that week. So you've got to meet this minimum 100% SLR target to retain your banking licence. Throughout 2007, RBS accidentally reported the non-sterling liquidity ratio rather than the sterling liquidity ratio. that the actual sterling liquidity ratio was less than 70%. So actually, they should have shut the bank down in 2007.
That's shocking. Now, can you tell me a little bit more about that human cost via the GPs? So, just before you do, it sounds as though these guys are doing business left, right, and centre, and not paying attention to what they should be, which is making sure they've got enough money.
There's various ways of looking at it. RBS were acquiring ABN AMRO. ABN AMRO had made a series of bad mistakes in terms of money laundering previously, but clearly had good access to Russian monies coming through their bank when required. I'll say a little more on that one. But effectively, Fred Goodwin was trying to build the biggest markets team on the globe.
Fred Goodwin was the head of RBS.
What banks do is they take loans and package them into something called collateralized debt obligations. They also use other packages you've probably heard of, credit default swaps.
So that's CDOs and CDSs?
Yes. So CDOs being the main thing they raise funds from. So let's say if I have a billion of loans, what I will then do is I credit grade those loans. And then let's say if that credit grade is AA or AAA, I can then borrow against that billion. And it might be averagely 4 or 5 times the billion. Yeah?
Right.
So the credit worthiness of my income stream is crucial to me. But what the banks were actually doing, and this is why they were all starting to having a liquidity issue, is they had all been selling these to each other as if they were selling grade A debt. But actually what they've done is package them or repackage them with very low grade junk debt. So without getting into politics, you're aware Sajid Javid. Sajid worked at Deutsche Bank. Yeah, he sold credit default swaps that had extremely high default rates.
Yeah.
30-40% plus. So £1 billion credit default swap could lose maybe 400 million. Just to give you an idea, some credit default swaps lost up to 90% of the value.
Banks, ABN AMRO, for example, was being bought by RBS. ABN AMRO was very big in this market where it was lending money and then afterwards grading all of the different loans that it had in terms of being really good, not so good, mixing it all up, making it look like it was really good.
Hugely overpaid for ABN AMRO.
Yeah.
And while I couldn't say for certain what the reason was behind that, as I say, ABN AMRO were caught up in a number of large money laundering risk issues with funds coming out of Russia.
Okay, so going back to RBS and the GP.
You've got a problem where the bank is hugely overtrading. Yeah, so it's massively exposed and it's aware of that. And what's happening is it's taking these hedging bets and it's starting to lose a lot of these hedging bets. So what it needs strong, high credit-worthy income flows, as much as possible, and it needs security. So RBS built package deals so that GPs could build or extend or develop larger practices. So they would go off and build, in this case, £5 million surgery. And the bank, where they would normally restrict what they will lend to about 70% of the value of the property, created a package where they would lend you 100% of the value of the property. So if you're going to spend 10 million building a surgery, they will lend you 10 million. But you had to have one of these hedging rate products. It was a condition of the loan.
Right. Okay. The devil is in the details. So let's go.
In the details. So in this case, we have a swap that is forward sold. So if you follow my concerns about RBS in 2007, misreporting their liquidity position, which they had to then tell the FSA, which the Financial Services Authority were the previous regulator. Effectively, the FCA is just a rebadged FSA.
Yeah.
They had to report the fact that they'd been misreporting that by accident, and the FSA accepted the fact it had just been a bit of an error for a year or so.
What was the consequence, though, in terms of the behaviour of the bank?
What
did they have to do to get out of that trouble?
Well, interestingly enough, the FSA started putting working teams in throughout 2007 and 2008 into RBS, which is interesting when you look at the way that the Financial Services Authority talk about the crash, because it's almost as if we didn't know it was going to happen. And yet they'd had any number of projects underway in RBS looking at all of the concerns and issues and liquidity risk, for well over a year before.
This is the background as to what was going on before this loan was made to the GP.
Yeah, so effectively in 2008, RBS's problems are getting worse. The liquidity issue is huge. They can only raise funds overnight in the wholesale market, so effectively they have no money.
They're desperate for money.
Every night they've got to go out and borrow money again, otherwise they can't open the doors the next day.
Right.
That's the position.
Okay.
So at the time this is sold, these people are about to build this surgery, but they're selling another surgery, so it's a complex, build. It's a £5 million project. So they're not actually going to borrow the money until 2009. But what the bank says, look, rates look like they're dropping slightly, but if you're going to take this loan, we want to know that we've got protection in terms of what you can manage to pay. So now is a really good time, because rates have dropped slightly, to fix your rate. So they actually sold them an interest rate of circa 5%. I won't go into all the details of it because I don't want to give the exact case away. Of circa 5% 3 weeks before Lehman's went. So at a time when Lehman's were in so much trouble and RBS were exposed to Lehman's, they will say on paper that we had £1 billion of exposure. But if you follow my discussions on leverage, and I said that you might have leverage of 4 or 5 times, it was sometimes 40 or 50 times at
So
banks.
just to say, a leverage, that's when you've borrowed 40 or 50 times more than you should be, or more than you've got.
Yeah, we go back to this loan product, and I've got £1 billion income stream, and because of the way I run my credit ratings and the way my auditors let me manage this balance sheet, I might have borrowed 25, 30 billion against that 1 billion.
Because people gave you the money.
Yeah, because I'm good for it. So I tell them. And my balance sheet tells them that I'm good for the money.
Right.
Unfortunately, however, if my balance sheet is largely built on the same subgrade debt that I'm selling on to everyone else, I may have a problem if anyone calls my bluff. So what was happening in 2008, RBS were hugely exposed. They had real problems. Or the only way they could try and survive the absolute crisis they were facing was to sell as many of these positions on to their customers as they could.
So an organisation that was lying and couldn't be trusted and was going around saying that they were responsibly running their bank were then afterwards finding people who trusted them and saying to them, we are going to help you out.
We're going to help you. It's like, think about this as an insurance. And of course, what you do, if you're selling investment products, you're supposed to give people a reasonable analysis of the period for which you consider the investment. So if you're buying an investment product that you expect to keep for 5 years, then your best analysis would be, how did it perform over the last 5 years?
Okay.
They were selling products going forward anything up to 10, 15, 20, 25 years.
Okay.
But what they were doing is going back over 30 years. So rather than saying, well, look, rates will drop as we know they will, which is what they knew from their own systems, they were saying, oh, look, do you remember 12% rates? Do you remember 30? Oh, 15% rates. Rates are so historically low.
So very selective snapshots.
Very wide snapshots of periods of history that were not at all relevant to that time period, when the whole global world knew there was a crash about to happen that was virtually unprecedented.
Now, is this something which is described in the financial press with the euphemism mis-selling?
Yeah, with these products, I would call it fraud rather than mis-selling.
Okay, it's very interesting that we're now on this, because so some people talk about this thing semantics. So what is meant with the language here? So mis-selling and fraud. Mark, I think you have come across various cases which aren't mis-selling, but they are fraud.
Yeah, I mean, I think you mentioned on and touched on and asked me earlier with regards to, trust. All I can really say to you and whoever listens to this is that we have whistleblowers that have already disclosed to us, and we're talking not one whistleblower, but multiple whistleblowers, that in their first week of work at RBS Corporate and Commercial, their week 1 induction, these new entrants were all shown how to forge customer signatures onto documents. And all I would say beyond that is the office joke was all the best business was done at the photocopier. And so when you ask about trust issues, I would suggest that people take on board what I've just said there.
And if you to just expand on that, when we say forge, we're not talking about computer cutting and pasting. We're talking about going into a section of the credit files where they have something called the individual signature verification, which is, do you know if you've ever opened a bank account and you have like a box and you've got to sign within the box? So if you write a check or they're ever unsure about who you are and you signing or handing anything over to transfer monies, they'll go into that section and check that mandate and say, oh yeah, that's your signature. So what they were told to do, or shown how to do, was how to print a copy of that out, hold it against the window, put up the document that had the signature missing, perhaps a loan document or other credit document, trace over that signature, so they had the right signature on it. They would then destroy the original tracing after they'd copied it. They would then run the whole document through the photocopier. I think was it up to about 10 times, Mark?
Yeah, it depends on how much they needed to fade and how old they needed to make the signature look. But, you would run it through the photocopy, change the tone, you'd turn the signature on its, so it's off square, just so that anything that would make it fit what year of document it was relevant to.
And this has been in the papers, hasn't it?
Yeah, that's been in the papers, and the whistleblower actually admitted he'd done it himself because he was just, I mean, at the end of the day, he would look back now and think, why did that happen? But it was a standard practice. And what they would then do is scan in the copied document into the system, so if there was ever any legal dispute later on in terms of recovery of money, they would produce a loan document or whatever was required, as signed by the signature, by the customer, they would say.
We were talking about whether or not it's fraud or mis-selling, and we've been talking about these selective snapshots that they were saying about interest rates going up and down in order to be able to sell, for example, to a GP.
Let me hone in on why I say fraud, and I don't just throw that allegation around lightly, but the key aspects of fraud you consider a false representation or failing to disclose, and if you have a risk with an investment product, as I say, as an advisor, you have to make customers aware of really the maximum potential losses with these products. That's what investment's about, even if you're not advising the customer.
Worst case scenario.
Yeah, you either, when products are sold, I mean, there's an interesting little sideline here that I fell out over the FCA with several years ago, where normally when you sell investment products, you sell them advised or something called execution only. So advising, you will produce a report. You'll explain why you've sold the product, what the costs are, what the commissions are, what the risks are. Execution only, it's a bit like just saying you want to buy £1,000 of the Barclays shares. You just call a broker and he's not advised you to buy Barclays. You know you want to buy Barclays. You're just simply going to agree a commission and that's the way it's done. So that's an execution only sale. These products were all sold execution only, which actually breaches the European directives.
You mean the loans to the GPs and these swaps?
These hedge products. Yeah, I reported this to the FCA back in 2014. I actually got in touch with them because they had 9,000 of these swap cases were going into what's called a review.
Hold on, I thought you said that it was so you are allowed 100% loan, and then afterwards the question is this. Then they force you to buy this insurance.
Yeah, but go back a step. What I'm trying to take you through in the chronology of is how do you end up with this deal? Yeah, so I'm the advisor. You're coming to me. You're one of my customers. Yeah, in theory, if I sell you an investment, I'm trying to sell you something that makes money.
Yeah.
So hedges are an investment. Yeah. So the whole point of a hedge is that you should either gain off the hedge or protect yourself and pay something for the protection.
Okay, so I'm borrowing money off you so that I can expand my GP practice. And then you're saying to me, so am I being forced into buying insurance or am I buying an investment?
You've been forced into buying an investment. You remember the good old days of the mortgage endowment scandal, where people were all forced to buy very expensive investment products that would never pay the mortgage off? Right. Yeah. So there was a big review over that. A lot of people got compensated. You're tying an investment product to a loan. Now, because commercial lending is not a regulated area, it's not the same as mortgages, which are a regulated area on people's homes, but the actual investment product itself is regulated. So going back to what I was saying, when people buy this product off you, and I don't want to bore you with technicalities, but the reason I'm explaining this execution on your advice position is if you're coming to me and I'm selling it to you execution only, you're telling me what product you want. I'm not advising you. I have no liability for advising you.
So you've spoken to me in a certain way, told me a little bit about interest rates and things like that, and then you've said, I'm asking you to force me to sell you this investment product.
Yeah, the way the analogy doesn't really work because the problem is you've never asked me about interest rates. If I'm the bank manager, I've actually come to you and said, we're really worried about interest rates and we think you should protect yourself or we want you to protect yourself if you take a loan out with us. So you haven't raised the issue of interest rates. I've raised it with you. Now that's problematic because that means the bank manager is getting involved in talking about investments. That's a big issue. Okay.
Right.
But then beyond that, effectively, if I'm advising you, you're going to get a report off me. I'm going to explain what I've sold you, why I've sold it, what the risks are.
And that didn't happen.
No, because these were sold execution only. But when I got into an argument with the Financial Conduct Authority over this, the Financial Conduct Authority said, no, they weren't execution only, they were non-advised. Now, this was interesting.
Is that a third category?
Well, it is in certain areas. So let's say if you're buying a mortgage, you can buy a mortgage on a non-advised basis. So effectively, you will talk to somebody over a telephone line. They will have a script. They can't lead you towards any product, and they have to stick to the script. And you can say to them, well, I want to have a fixed rate or a variable rate or a mortgage for X amount of years. And they have to stick to the script and can't lead you towards a product. And if they do that and they get to the end of the script and you want to buy a product, that's non-advised. In fact, if you looked on the FCA's website about non-advised sales, there was a 1-minute guide to something like pet insurance or holiday insurance, as I recall. So non-advised is an area you would only rely on for very simplistic products. However, the problem that the banks and the FCA had is the issue of the interest rate selling was in the billions at a time when they were largely insolvent. I originally wrote to Martin Wheatley in 2014 thinking I was being very helpful.
Who was in charge of the Financial Conduct Authority?
And I just thought the FCA had made a simple mistake because they had 9,000 cases going into this review from RBS.
So this is the optics, right? This is how it looks. A desperate bank which cannot represent its own information honestly to the regulators. They are desperate to get money back and are offloading their poor bets onto GPs, for example, who they regard as blue chip income, public sector money, taxpayer money, by forcing them into buying investments and making it look as though the GPs have said, you are to sell me this investment without giving me any advice, even though they had pushed them into it.
They would come along with the presentation. They would say they would offer 2 or 3 different types of products, but actually they would only push them towards one, which was the swap, because you can buy something called a cap. So you can actually buy something that fixes your rate at a level, and it's not that expensive.
When is this happening? 2000? This is just before the Lehman Brothers crash.
They've done it since year 4, but in the year 4-5 deals, they weren't anywhere near as toxic. They weren't great deals, but you might have won or lost on them. 6, 7, 8, 9 particularly, because what they're doing, and let me try and put it in simple terms. Let's say you're going to buy a factory for £2 million, and you want to borrow £1 million off me, and your concern is that if rates go up, you won't be able to afford to pay for that factory. So at the time you do the deal, let's say rates are 5%. Okay, so let's say if it's interest only, it's going to cost you £50,000 a year. Yeah, and let's say you expect in 10 years you're going to get some money from somewhere else and pay it off. So you've got a 10-year loan, it's going to cost you £50,000 a year if rates stay at 5%.
Okay, that sounds pretty simple.
Because you want that security. You've worked out that if rates go above 6%, let's say, you've got a problem. So you might do a deal with me and fix for that 10 years at 6%. Now, that's going to cost you £10,000 a year. If rates stay at 5%, you've got that £10,000 cost, but you've got the security of knowing if rates go up to 7, 8, 9, 10, I'm going to carry all the losses for that. So we both know what we're doing in that scenario, and effectively we do a deal that works for both of us. That can be a swap as well, depending on where rates go, yeah?
Okay, and so what happened with the GPs then?
Okay, so going back to this scenario, the value of a loan on your books
This is if you're a bank.
If you're a bank and you want to improve your balance sheet, the value of those loans on your books will be dependent on the income streams and the creditworthiness. Okay? So let's say if I as a bank expect interest rates to go down to 3%, fairly soon, then and we do that same deal, and it's at 6%, and rates drop in the next year to 3%, I've got a £30,000 a year income stream from that fixed rate. And if that's 9 years left on the loan, that's 9 years at 30,000 on those projections, 270,000. I can put that value on my balance sheet.
There's a lot of money to be made by banks in that situation from targeting GPs, for example, and small businesses.
It's the biggest balance sheet fix you could ever get. And the longer the loan is and the longer the fix is, the higher the return, because all of the forecasts were downward in 2008.
This is a large-scale fraud, then, that you're talking about that the bank is engaged in?
Yeah, I would say it was. Ultimately, they could have waited until 2009 and taken the loan and a swap in 2009, in September 2009. Interest rates were 0.5%. So had they wanted to take a fix, shall we say, they might have fixed at 1.5% or 2%. Instead, they had 5%, plus the margin on the loan. So in 2009, when you take these fixes, you also have your loan margin. So the bank might be charging you 1 over base or 1 over LIBOR. So they might have had a combined fixed rate of about 2.5–3% in 2009. Instead, they had a combined rate of circa 7%.
As someone who works as a financial advisor, or has done, you can have people come to you, like these networks of GPs, saying, I've been missold. Actually, this is not right. Can you help me? And also, you know, people who are contacting you through Bank Confidential saying, actually, we know about the misselling of this stuff. So in terms of information, you've got various streams of information coming to you, and you've built up a very interesting picture that you're telling me now.
With something like this, Ranjan, these people went through the IRHP review,
Interest rate
hedging product review,
right.
and got no compensation.
Who ran the review for these GPs, for example?
Oh, the bank ran their own review.
Okay. And this is just RBS or several banks?
All the banks ran their own review. All the banks had to review these products, and there's something under the FCA has powers under the Financial Services and Markets Act to force banks to review what they call mis-selling. And so effectively, they can then appoint a skilled person. That's a separate firm. In this case, it was KPMG. They will, in theory, oversee the review of the products. And if they're found to have mis-sold, then they have to compensate the customer.
So it's not marking your own homework, but it's pretty close?
It's marking your own homework and bringing a friend in to say that you've got it right. So effectively, what happened here, the bank were rushing to get as many of these deals on their books as they could, because as rates start dropping, obviously, they're not going to make as much profit.
And let's not forget the directives from above at RBS, which was to all of the portfolio managers, any borrowing over $500,000, they wanted swaps.
So effectively, there was a rush to get these people sold as rates were about to start dropping. So these GPs were sold this in 2008. Now, what they were not told about at the time, bearing in mind they're borrowing $5.2 million for a $5.2 million surgery, is that the banks have calculated the expected losses going forward based on these systems, as I've shown you here. And then what they do is they put credit in place for those losses. Keep it in simple terms, that the potential future losses are called contingent liabilities. So anybody who accounts for contingent liabilities, it's an event that might happen, could happen. What you're looking at is the contingent liability for the period of the loan.
What could go wrong?
Effectively, it's the bank's expected income stream from your losses on the fixed rate. That's what it is.
I borrow money,
Yeah.
something could go wrong, and the bank has created some metric that measures what could go wrong, but there's some income that they will also get if things go wrong.
No, they already know they're going to get an income if it goes wrong.
They've
Because
designed something. So can you tell me, how have they designed something that means that they win if things go wrong?
if I think interest rates are going to go down to 3% and I fix you at 7%, it's not rocket science. Go back to that £1 million analogy. If rates go down to 3% and stay at 3%, you're going to pay me £40,000 a year for the term of the loan. That's the money I make on my investment bet, and that's the money you lose.
Okay, and they've counted how much they're going to make.
They have to. They have to, for their own accounting purposes. The markets team have to know their exposure. And what they don't tell you is they will put a credit limit in place for those risks. It's called margin credit. Okay, now think about it. It's like having an overdraft at a bookies for a spread bet. It's like having an overdraft and saying, you know, you're £9,000 in your £10,000 overdraft, but we're not calling the overdraft in, therefore your £9,000's contingent. Well, it's ludicrous. You owe the £9,000. So the credit limit at the start of this product, because they sold them a 25-year fixed rate just before rates crashed, the initial credit limit was 1.9 million. So the bank expected, on top of the loan monies they would recover, the 5.2 million, on top of the 1.25% interest rate they get, they expected to make another 1.9 million over 25 years on this deal.
And they know that from day one.
They expect that from day one, because forward yield curves can change, therefore wins and losses can change, but they expect 1.89, but actually they kind of expect more because they know rates are going to start going down more severely.
I want to expand my business. I borrow £5.2 million from the bank, and then on day one of borrowing the money, the bank have got some measurement that they have to declare to themselves.
No, it's not declared to themselves. It's an actual credit facility in your name.
So I've got an overdraft.
You've got an overdraft that's called margin credit for your losses on this investment.
I have a £1.9 million overdraft.
Yeah, which is problematic because you're 100% loan to value on your loan. So effectively, if you miss a loan payment, I'm going to have to rely on all your personal assets to cover that risk.
So I think I've borrowed 5.2, but I've actually borrowed 7.
Yes, but I just haven't told you you've borrowed 7. However, my internal credit files will show that you owe me 7.
So that sounds quite fraudulent in the sense that if I were the GP and I didn't know that.
Well, they're told that there might be a break cost to get out of this deal. So they're told that there might be a break cost, but the bank don't know what it is, and we can't really calculate it, and it all depends when you get out of it. The bank's own systems measure that break cost from day one alongside the contingent liability. That's fraud. If you go back to this analogy, what is a good trade for the bank? If I'm selling a 5.2 million loan and making nearly 2 million on top of it, it's a pretty good trade, I would suggest. By the time they actually start the loan, which is a year later, that contingent liability is at 3.7 million.
So the types of information that the bank have, the customer doesn't get to see.
And what the internal credit files will show that they've asked all of the GPs and the practice manager to give them details of all their personal assets and liabilities, their homes, their investments, because ultimately they're relying on all those personal assets to cover this investment risk.
And they've gone for them now? 10 years later, have they gone for them all?
No, what happened in this case, your risk is very simple. Had they missed a payment on the loan, once you're 5 days beyond the missed payment, the bank has to close out these trades, and they will either claim a break cost or go for, if possible, if there's an insolvency position, the maximum amount of the losses. Which
so
is
early doors, the bank will just say you owe us 7 million.
If it's insolvency, they say 7 million. If not, it's maybe slightly less. But ultimately, what would have happened in these cases is you would have had 4 bankrupt GPs and a practice manager. What happened in this case is they were under financial pressure for the whole 9 years that they held this product, because obviously interest rates are down at 0.5% and they're paying 7% on the loan. So they're actually having to put some of their own monies in to support the payments.
And they're getting letters from the bank telling them all of this stuff.
Except the bank don't happen to mention this credit facility and this credit risk.
They use different language.
Yeah.
But they say you owe us this.
No, they're just making the payments all the time on the 7% interest rate. But obviously what happens is where rates were moved down in theory to give businesses a chance to have more liquidity, what happened is the banks took all that liquidity by fixing as many customers as they could on high rates.
So there's no big conversation here. The GP just sees the money go out of their account. But in actual fact, this is the story in the background.
But they want to try and get out of the deal because they don't want to pay 7% per annum and it's costing them money. But they have this break cost in the background, which they're told is 1.4, 1.5, 1.6 million.
This is some serious gangster shit, isn't it?
The issue you have here is you also had another problem in that the way these swaps are set up, if any member of the practice dies or wants to leave the swap, it breaks the swap. So one of the GPs worked 2 years beyond retirement, another one left with ill health but couldn't get out of the deal and out of the risk. So the only way they could solve this problem was to sell their surgery to a third party.
And these people are supposed to be looking after the community.
These are GPs looking after the community who couldn't grow the practice because nobody else could join the partnership, nobody could leave the partnership. Yeah, so all their plans to merge and grow this medical centre couldn't move forward. And effectively they ended up having to sell the surgery and pay a £2 million penalty. So after 9 years, they'd paid £2 million out already on the swap and another £2 million penalty to get out of it. So on a £5 million loan in 9 years, the bank recovered nearer £10 million.
And that person is no longer practicing.
Those people are practicing, they now rent their surgery back from a third party. What you have RBS making huge profits from NHS subsidised income, GP surgeries that can't grow, GPs under massive pressure, and when they went into this interest rate hedging product review, they didn't get any compensation, which was highly unusual because in most cases, 25-year fixes and hedges were either reduced down to 5-year hedges, in which case they would have probably got £1 million back and this break cost would have gone and they could have kept the surgery, or they would have got some form of compensation.
But tell me that you've helped them out.
No, we're working on it now with the bank. At the moment, the bank and the FCA don't seem to want to look into the issues we found. So I couldn't understand why they didn't get redress in the review because, as I say, in other cases I've looked at, 25-year deals were always redressed. And it was such an obvious one. It was forward sold by a year, so it was a very risky product, sold very badly. So I would have expected this to absolutely get redressed in the review. Unfortunately, when we looked into the files in the review, and this is where I confronted Mr. Bailey at the FCA meeting.
Andrew Bailey, the head of the Financial Conduct Authority, apparently he's in the lead position to become the head of the Bank of England.
Current chief executive of the FCA, next governor of the Bank of England, will shortly be the most powerful banker in the UK. So I gave him evidence that showed that when this file was being prepared for the review, and there's a document I can show you here, which might help to explain. So this is from an internal RBS credit system. Where I've spoken about this loan and this credit line, you can see there that there is a credit line of 3.7 million and a loan of 3.2. So if you look at the bottom here, if you just want to read out what it says there.
Total direct exposure for Connection,
And how much is it?
£8.9 million.
So that's the exposure that the group say they have to this GP practice. So that's your 5.2 million loan plus your 3.7 million additional liability covered by a credit facility that they knew nothing about. So just before this went into the review, these people had complained about the product, complained about the losses. Their bank manager got a call from the treasury arm of the bank. We don't know what he said to the bank manager because they've redacted all that from this credit document, which is unusual because this is credit for individuals, so we're entitled to all of that information, which we challenged through the Information Commissioner's office, but again, they were not helpful. So for some unknown reason, the Treasury representative called the bank manager and instructed him to reduce that credit risk from 3.7 million to 1.44 million. That was the same value as the break cost, the cost to get out of the deal at that time. So effectively, a file note was then prepared for the review, which said that the contingent liability was 1.44 million and the credit risk was and the break cost was 1.44 million.
Okay, so they rigged, they falsely represented what they had down on their books as
Yes.
what they could make from this people.
And under the review, the RBS had signed an undertaking to the FCA that they would comply with all the rules of the review. So I have, in writing from David D'Souza, who was a technical specialist on the review, working on behalf of the FCA, I have confirmation that the contingent liability had to be considered in the review process. It was the biggest risk on the investment product.
And it was, but they just considered the wrong number.
No, unfortunately, it wasn't. Not only was it the wrong number, we also hold the internal files on this case where KPMG said that they're not considering the contingent liability because that's an internal mechanism of the bank, and this is in line with their agreement with the FCA.
So there's a lot of cover-up here. What are your thoughts on all of that? Because, I mean, I know that you've got, cover-ups can be distracting and, there's lots of different regulators in this country. So it sounds to me as though the FCA are complicit in all of this fraud and they're helping to cover it all up.
If you look at this credit risk, this contingent liability that I've been trying to get in the press for many years, and the first article came out on this about 2 weeks ago.
Was this the Reuters article?
The Reuters article, yeah, talking about this case and other credit risk. So I've been trying to get this exposed for many years because I can't understand why anybody thinks it's right that you can actually apply for credit in an individual or a company's name without their knowledge for huge liabilities, put facilities in place without their knowledge, and those facilities are all secured against that customer's assets. Many companies within RBS ended up in this GRG arm, this troubled arm or troubled business arm. Many of them ended up in there because of these credit facilities that they'd never even been told about. So companies actually went into insolvency because of credit facilities they knew nothing about, had never been told about, but were secured against their properties. Now, because most of the companies who buy these products are limited companies, you do not get this internal credit information under the Data Protection Act. So the only time you can actually get this evidence is when you're dealing with individuals.
So limited companies, they are not entitled to know about these things.
I'm speaking to somebody at the moment who bought one of these products 12 years ago, has been fighting for years to get compensation, had never heard about credit lines until I was putting something on Twitter out about it. And this is Europe-wide. It isn't just the UK. I've accused the FCA of covering this up because there was mooted at one point to be around 30 billion due in redress in the IRHP review, in the swap review. In the end, around 3 billion was paid out, because the whole review was designed in such a way as to ignore these risks, ignore the way people had been misled.
It's been very interesting finding out about this, and obviously I'd like to get you in to talk to us about this a little bit more in the future, to give us the latest in terms of the battles that you're fighting on behalf of your clients, the stories that you're getting from whistleblowers. What would you say to anyone that's been listening to this right now in terms of where they could either get more information about this?
Well, I think there's two things. I think, one, a lot of people tend to think this doesn't affect them because they're not a business who bought one of these, or they're not in business, or they're employed by somebody. What they don't realise is that there was huge indirect taxation on the UK economy by things such as these products. When the banks were in difficulties, not only did they go on and sell their positions to their own customers, they did it through private financial initiatives, You've looked into Lurbos before, where there were this type of fixed rate loans.
On local councils.
Yeah, absolutely. So effectively, what the banks did is went out and all the sources they could get their hands on of public income tried to sell these fixed rate products. So the very taxpayers who bailed out RBS were being taxed again through these NHS income streams and elsewhere. And the reason, as I've said to you before on this, Ranjan, the reason we've got austerity in this country is because we have been filling the bank's coffers for 10 years now. People talk about 42 billion or 25 billion. I did a meeting with Andrew Bailey and with Mark in relation to another matter, and he was saying in that meeting, if I hadn't given 25 billion to RBS, do you know what would have happened, Mr. Middleton? And I said, yes, I do know what would have happened. I said, but you didn't just give them 25 billion, Andrew. You gave them around $1 trillion.
This is not state-backed capitalism. This is state-backed cannibalism, isn't it?
It is. And what I say, what people don't realise is the extent of the liabilities that the government took on for the UK banks was around 1.4 trillion at its peak. Yeah, so they took bad debts on, the guaranteed loans. Yeah, the risks we took were virtually 70% of UK GDP for a year. But the effect of that ongoing is huge, because not only do you have things like, and this GP surgery, you're not alone, there are many GP surgeries who went through the review and didn't get redressed. I've spoken to other surgeries, again, who are saying, Steve, we're going to have to sell our surgery. It's the only way we can deal with this. We can't keep paying these rates.
I understand that there's a whole generation of businessmen, small businessmen, waves of suicides, austerity, all of this type of thing going on.
I dealt with a case over in Wales where a businessman had killed himself because the bank were trying to take his house off him. And what the bank had done, they had replaced a normal mortgage with a commercial loan, and they'd done a personal guarantee and attached one of these credit lines to his home as his risk. And when the swap was broken, they were trying to recover £200,000 of those monies. He didn't know that liability was even there. And I've dealt with numerous cases where people have been suicidal, had on the verge of losing their homes, on the verge of losing their businesses. 2 or 3 bank managers at a time turning up to pressurise them into taking higher rates, break the existing loans. It's quite stunning what you see.
And the coverage of this, because obviously we're having a conversation about this right now, but the coverage of this, I mean, I noticed that sometimes this is occasionally mentioned in some sections of the business press, but it's, you know, the adjectives and the verbs that they use are strong, but at the same time, you know, they move on to the next sentence and the story's over very quickly and forgotten about very quickly.
Ranjan, Mark and I as financial advisors have sold thousands and thousands of investment products. We are used to the compliance levels we are used to do that, the boxes we have to tick, the I's we've got to dot, the T's we've got to cross, the documents we have to hand over, because it's all about consumer risk, and we can't possibly sell something people might lose money over unless we've made them aware of it.
But so how did all of this happen?
You tell me, because after years of being compliant to high heaven, how do you think we then feel when we see the fact that the banks have literally gone out and sold loss-making investments by the tens of thousands to their own customers?
I think that to add something there, Ranjan, is quite significant. I mean, I and other whistleblowers at RBS had already given the name of the designated signature forgery trainer at RBS to Andrew Bailey, the CEO of the FCA, a year before it was front page of the Mail on Sunday, and he did nothing with that information.
Even worse than that, when Nicky Morgan confronted him in a Treasury Select Committee meeting, she asked, was he going to make sure he saw Norman Lamb and the people who had released these issues and the whistleblowers? And he said that he'd been trying to. It's very difficult to get in front of them or arrange a meeting. We'd had 2 meetings set up that year, both of which he dropped out of at last minute. In one case, we had a hotel room booked and an office set aside in the hotel, and we notified an hour before the meeting that he wasn't coming. And at no point after being given the name of the person who was training people to forge signatures, at no point did he come back to Mark and ask for any further information.
This is obviously shocking stuff, and I look forward to hearing more about this and updating people through your own channels and through ours. Thank you very much for coming in.
Thank you.
Thank you.